Hello, welcome to ETBFSI.com. My name is Amol Dethe and I'm in conversation with Mr. Sanjiv Chadha from BOB. So glad to have you.
Thank you.
So congrats first of all on the profitability. Good numbers, must say, after a long time. And as you mentioned that you haven't seen this credit growth in the Indian economy or specifically in the banking sector. What I would like to learn from you is what are the major drivers for this profitability? Because the capex cycle is still not huge. Obviously, there is a future prediction that it will grow up. But in the last quarter or last quarter, still it was not very high. So what are the major drivers behind this profitability?
So I think first of all, there is a cyclical improvement which is there. The corporate credit cycle has been improving for the last very many quarters, and this improvement actually happened even through COVID. So you see, there's been a progressive reduction in the credit costs. So that has had a very large impact on bottom lines.
Right.
The second part, of course, is that we are now seeing credit growth pick up. In particular, retail credit growth has been very, very positive. So that's the second part. The third is the change in the interest rate cycle. We would normally expect that in the beginning of the cycle, the banks would benefit because of the lag between the repricing of loans and deposits. But I think the fourth factor is something which is important for us and which we believe again impacts BOB much more. I think we were very successful in how we executed the merger. That meant that today, as we speak, we have a lesser number of branches by a significant margin as compared to 3 years back. We have a lesser number of people, but we have been seeing very robust growth. Depending on what you want to see, you might have actually a book which is 30-40% larger as compared to what it was 2.5 years back. And now when we are at that stage of the cycle where growth is picking up, this quarter our YOY growth in loans, in fact, for 9-month period, it has been about 20%, and retail is 30%. Now, as this growth gathers pace and continues, and the cost increases are not proportionately there, I think there would be a widening of margins and benefit really uniquely accruing to the bank. I think this is something which should continue because of the fact that the investments made by the bank in digital have meant that the link which was always there between costs and revenues, that has been broken. Today, 5 times as many customers use Bob World as those who come to our branches. That proportion is growing up. The marginal cost for people who use digital as the primary mode of banking is minimal. And therefore, again, I believe that in terms of cost income ratios of the bank, we should be seeing steady improvement as we go ahead.
Okay, noted your point, sir. So let me shift your focus specifically in the outlook, and I would like to learn more from you specifically on the credit growth. Given the background of the budget where 33% outlay has been given to specifically capex, what kind of credit growth specifically that you see? And also, if you could tell us which are the sectors, because in the result presentation you also mentioned and highlighted a segment called road and infrastructure.
Indeed.
So which are the segments or sectors specifically that you see will be the major drivers of growth going ahead?
Yeah. So you are absolutely right. I think there has been a very strong link between the capital expenditure of the government and the sectors which have seen growth. This intervention has worked A, by way of money that has been spent, but B, also in terms of how the operating environment has been altered to make the risks again less. As you mentioned, the road sector is a very clear case in point, where because of the hybrid annuity model, you have a fund flowing from the government to the NHAI in terms of viability gap funding. 2, the regime requires that you should have actually acquired 90% of the land before you start a project. It also means that once a project is complete, the market risk does not impact banks because there's an annuity which is in place. So I think the intervention of the government selectively in the sectors that really matter is something which has had a very big impact. And now with the 33% growth in capex, the scope of that salutary impact is that much more. So I would believe the sectors again which have benefited most by the government in terms of road projects, in terms of green energy, solar power projects, in terms of defense, these are the ones which are likely to benefit. And of course, then these have the second order effect on sectors like cement, on steel, which again works very well. And also we are seeing along with that finally that the private sector investment cycle, while not being back fully to normal, is improving. We used to talk of only one or two segments again where you were seeing private sector expenditure. Now that is something which is a widening spectrum with each passing quarter. So I would believe that these two acting in combination, along with again the prospects of the economy, the fact that relatively speaking in the global context India is doing very well, I think all of this should add to the growth momentum as we move forward.
Right. So absolutely. I mean, there's a sense that you are getting specifically that the private cycle is picking up. But how far will it go? What kind of speed it will catch? Because still the interest rates are very high. At least if you compare to what the RBI had given a reduction specifically during the COVID time, and that was also one of the worry. So yes, the big boost is there from the budget. Big boost is also from the government side. But the interest rates are also very high and the inflation is still not under control. So do you see maybe the cycle will pick up, will improve, but still it will have some speed breakers going ahead?
So I think while it is true that any improvement in cycle is gradual, I don't believe it is the interest rates which would hold back growth. Because if you see, go back last 2 or 3 years when actually growth was low, interest rates were at the rock bottom, right? But that was not enough to catalyze growth. Also, if you look at again the context of 4 or 5 years, interest rates today are no higher as compared to where they were when the economy was functioning on a normal basis pre-COVID, right? So we are pretty much in a normalized interest rate regime rather than in an elevated interest rate regime. What you're saying is correct for a number of economies which are experiencing interest rates which are at 30-year highs, but that is certainly not true for India. So I don't think that is what will hold growth back. I think what of course is important is that the kind of enabling environment that we have seen, as that becomes characteristic of different sectors, we will see growth. Private capital is there. It is looking to make sure that you get the appropriate return on equity on a risk adjusted basis. With a lot of interventions, I think the risk which is there in projects has come down, and therefore again the return on risk adjusted basis is positive, and you're seeing investments there. I think the PLI scheme is another case in point where of course you have the advantage of getting some incentives by way of cash for investment made. But equally important, it is the signaling that the PLI scheme gives, that these are areas which are important for the broader economy, these are areas which are a matter of government priority, and that enabling environment will be there to make sure that investments that are made earn the appropriate returns.
Quite meaningful, sir. So let me move your focus to the very important point about the reducing branches and also the staff, and still you achieved higher numbers. You mentioned that in the presentation also in the morning. Is the reduction in the branches or the staff, is it a gradual process or it happened because of the amalgamation? But what is going to be the next step? Will you still continue to add branches, or will you take a pause here? And also, will you hire, external talent, lateral hiring specifically, considering the skill development is really high?
So I think the fact is that the bank is growing, and to grow, you will require more distribution channels, and you will also require talent to service your customers. It is only the nature of these two categories which is changing. What used to be a physical branch, now that is, instead of that, becoming a mobile phone possibly, or even quite probably now you'll be investing in making sure that the physical footprint of the branch is more appropriate to the kind of customers who actually now come to the branch. Today, for most customers, it is the mobile phone which is the primary interface with the bank, and things which cannot be done on the mobile phone or some supplementary requirements in terms of information, those are met by the branch. So I think what we are looking at is again also not only looking at opening some new branches where they are required, and that is happening because we are a country where urbanization is still happening. There are always new outlying areas which come up which require branches, so branches are being opened. But along with that, I think the physical structure of branches needs to be changed. Today we are already in a program where we are altering the physical footprint of 2,000 of our 8,000 branches to make sure it is more appropriate to the kind of transactions that are happening in branches now. So investments will happen, but there will be more by way of making sure that the bank today answers more to the description of what the bank want of us today as compared to yesterday.
Oh, sure. Let me also learn more from you on specifically Bob world. We have been hearing a lot about the digital world. what kind of contribution the whole digital lending, digital disbursements, digital acquisition of the customers in making your balance sheet? Is it that significant number now?
I think it is very, very significant. As I mentioned, the fact that we are able to talk of 20% growth in loan book, 30% growth in retail loans, and retail loans more particularly because that is something which is manpower intensive and largely branch led in the past. The fact that you can grow your retail loans by 30% without adding numbers, right, or without adding new branches shows again the power of digital. Even when people come to branches, the interface has changed. Every saving bank account that we open today is through a tablet, right? So it means that you have almost a standardized customer experience regardless of which branch you go to. So I think it is also the qualitative experience which is undergoing an impact, and which is why you see that when we look at our deposit growth, I think it is significantly higher as compared to peer group, because we have been able to transform that customer experience over the last few years.
Sure, noted your points. Sir, also, again, you partly discussed that in the result conference as well, but I would like you to tell us, because the story is about the large conglomerate of India and he's a big billionaire. Though your exposure is very limited, that you said, but going ahead, do you see a worry because the regulator is reviewing, the global rating agencies are also going negative against in terms of reviewing the whole procedures, and people are not going very positively about this particular company called Adani Enterprises. So what is going to be your strategy going ahead?
So I think I can only comment on what is the likely impact on the bank and the improvement that you have seen in the bank's performance, whether that trajectory is likely to be altered or not. To my mind, for the very reasons that you talked of, the fact that it is a very limited exposure, the nature of the exposure. I also mentioned how it is risk mitigated by the fact that some exposures are in joint ventures, again with public sector companies, or again backed by guarantees of public sector companies. For a variety of reasons, I believe that any downside risk for us, should it be there, is very, very limited. Also, I think the improvement that we have seen in terms of credit costs, in terms of the overall corporate book, you would have seen that our slippages in corporate are almost zero. I think just about 13 crores this particular quarter. The credit costs are down to 0.3% for the quarter. So in terms of the resilience in the bank's balance sheet, it is something which is important. The other part again is that what we are discussing is largely a one-off related to certain issues which might be there for a particular group. If we were to look back 10 years, there were issues which were there in the broader corporate market in India, certain industry segments. There was an issue with the entire infrastructure sector, right? There were issues with the power sector which was there. We talked of road sector, there were issues. I don't think we have any broad issues. In fact, we are at the possibly the most favorable time in terms of the corporate credit cycle. And to the extent that I can comment about the bank and the sustainability of the progress of the bank, and also the possible downside impact on the bank, I think there's virtually no downside impact, and I'm very confident that regardless of this, the improvement that you see will be sustained.
Sure, noted your points, and that comes to my last question, just specifically about the economy as a whole. Though everybody is claiming and betting high on India, even governor and all IMF and everyone is saying that India is a bright spot, but the geopolitical tensions are still very high. Russia-Ukraine war is still having a lot of impacts on every economy of the world. And in fact, the economists are naming it perma crisis or poly crisis.
Indeed.
Given that condition, how do you see the India's growth going ahead, maybe in 2 to 3 quarters? Are you worried? At one side, we are seeing the cycle picking up, credit cycle from the private side. But are you at some corner worried that recession may hit, that credit cycle may see some speed breakers?
So I think India, possibly like the US economy, is largely what you can call a continental economy, which is mostly domestic led. If you were to break the GDP, maybe 3/4 is linked to domestic factors, a fourth might be linked to the external environment. To the extent that is linked to the external environment, we have a slower growth rate as compared to what peak growth rates could have been. So when we talk of potential growth rates, we say maybe there might be a potential growth rate about 7% today, right? Because the external environment is not very favorable. But the internal demand dynamics of the economy again are very, very powerful. We are also seeing a cyclical upturn. We talked in terms of the corporate credit cycle. The fact that today the capacity utilization rates are somewhere in the 75 to 80% range means that to take care of domestic demand, there will be investments as we go ahead. In terms of retail, we have the confidence that it is our retail segment in terms of loans which could withstand the tests of COVID and come through unimpaired. In terms of the corporate investment cycle, the corporate today who are investing are those who have deleveraged balance sheets. So I think there's a lot which is going for India, and I think we can be fairly confident as we face the future.
Sure, sir. Thank you. Let's hope the same positivity will continue in the economy as well. Thanks for sparing time with us and sharing all these insights. Thank you so much, sir.
Thank you very much.